It's out. You can even see it now on Property Guru. $437,000 selling price. My purchasing price back in 2011, $333,000. So a net gain of $64,000. Wow, amazing, right? Actually, maybe not. Today I'm going to share with you a very unique bearish point of view, as well as share with you my own thought process. I think these are very rare to hear, and as always, if you think there's something good for you in stock, smash the like button early. And with that, let's roll in the intro video. Hi guys, welcome back. Without further ado, let's dive on to some numbers. What does this $64,000 gain actually translate to in percentage terms? 64 over 373, that is actually only a 17% gain. My holding period was 10 years plus, and at the start, there was leverage because there was a loan. And year 6, if I'm not wrong, I cleared that loan, which means there is no loan to it. So if you count from an IRR perspective, I think it hovers around 2% per annum only. Even less than HDB, even less than CPF OA rate. Then the usual question maybe it's resale. That's why the real return is so lousy. So if we compare it to the overall resale index, I have something interesting from SRX that shows data from resale condos. If you look at the extreme right, you see that data on condo with leverage suggests a median rate of return of 68.3%. Wow, 68.3%, while an unlevered median return was 27.2%. Take note again, if you are on your second property loan, you can only loan up to 55%. That means you are definitely not fully levered also. And that's why decoupling is so pervasive these days with married couples who have spare cash on hand. Another part of reason, of course, is ABSD, which we'll touch on in a while. In this graph, however, there's also no mention of holding period. It's not mentioned whether the flats surveyed were bought before 2008 because there was one wave up, correct? So for someone who has bought a flat in 2008 and all the way to 2022, there'll be 2 waves up. And delivering 68.3% with levered returns is actually quite possible. But what I want to draw your attention to is actually on the left hand side. What do we see on October 2021? You realize that unlevered returns was only 19.5%, correct? And levered returns were only 36.3%. And take note again, this is with 75% LTV ratio and 2.25% per annum interest rate factored in. These days, fixed packages are already 4.25%. So my question is, what about returns for anyone who has sold out in 2018, 2019 or even 2020 before the run up in the last few years? To answer that question, I'll show you data points regarding my own HDB resale flat, and the price actually sucks. You'll see that in 2018, 2019, 2020, everyone in my block was selling around $300,000 only. Now everyone will be telling you, maybe this HDB flat is an old property, 35 years old already, but remaining lease 60 plus years only. But my rebuttal to that is, my flat was 4 years younger back then. Today is 39 years old already, and I managed to fetch $437,000 instead of $300,000 plus. Yes, Bala curve matters, but my question is, isn't the property cycle more important? These days, every property ad is going to tell you should buy new property launches. Check this previous tutorial out. I have this myth buster on properties not showing appreciation after 15 years. I think it will be an eye-opener. I'll leave it towards the end of this also. But I still haven't answered the question as to why I'm selling, correct? If you look for news articles for forecasts for 2023, you'll see rosy numbers. Projected 6 to 8% growth in HDB resale prices. If that were to be true, I think some lease decay can still be tolerated because the price will jolly well appreciate even more. Not just that, my own HDB flat was rented out at $2,000 per month. And as you've heard on the ground and seen on news articles, HDB rental rates have been skyrocketing. I could easily command $2,700 per month in terms of rental rate. If we factor that in, that would be a yield of 7.5%. Which means also, if I factor in the price appreciation of the HDB flat, I could be in total missing out close to 15% worth of gains by selling now. Crazy, correct? No wonder my friend said, hey bro, if you're not upgrading right away, keep the flat for rental, why sell right now? That is a pervasive point of view. Kevin Fong from PropNext has also mentioned something that is relevant to this. Homeowners are reluctant to sell for several reasons. The rental market is booming, they would rather rent it out for recurring income than dispose it off. So the question backs again, why not keep it? Now speaking to here, I suddenly thought of this saying, what goes up must come down. Maybe not in property prices in absolute terms, because HDB flats are not going back to $100,000. I get that. But the deeper logic might be, what got it there may not be enough to get it further. I'll take a pause on that point of view and bring in today's video sponsor, who is OHMYHOME. I've actually engaged OHMYHOME to sell my property. The views presented in this tutorial are solely for myself, but I'm happy to collaborate with them simply because they have helped me sell my property in an efficient manner. I first contacted them in September 2022, and I've actually gotten my offer end of October 2022, just 1 month plus of marketing. So if you're struggling to sell your flat right now, I would suggest you can actually contact OHMYHOME, whereby I'll leave their links below to book an appointment with them. The appointment is actually run by an agent, and by the way, this is my agent. But the marketing is actually done by a team rather than just an individual agent. So you can see from my listing, it's actually listed on the best platforms: Property Guru, SRX, and 99.co. And from my experience, this is a very big difference, because if you want results, you need exposure. So if just as you're thinking of putting up your home for sale, check out my links below. You'll be matched with one of OHMYHOME's outstanding agents for your area, and this was the process that I went through myself. They actually run through a home valuation report for your property to help you determine the right price to sell at. And when everything is decided, you actually see their dedicated marketing team working on to get your property to the right audience. So again, check out my links below and get in touch with OHMYHOME today. At this juncture, we are moving towards a new world whereby low interest rates may not be seen for quite a few years. And as we look back in time, it was not banks, it was not industrials, it was not energy that benefited the most from a low interest environment. It was none other than technology. In a previous sharing, I've mentioned before that technology was able to scale with low interest, and because of their nature, they've been able to exhibit the largest growth rate, and that's why they've been the biggest beneficiary. Property, in my opinion, is a close second. Because when you buy property, usually there is a loan attached to it. A loan allows you to make money using other people's money, which means if the rate of return is indeed 6 to 8%, and if your borrowing cost is 4%, you can make monies with other people's money. That is financial literacy 101. And that's why the conditions were so Goldilocks before 2022. Moving forward, I'm not too certain. And here are some points that I'd like to share with you for consideration. The first regards rental rate. 2022 and before, the economy was strong. Stimulus from global lockdowns was still moving through the system. Not just that, in Singapore, new projects were being delayed. BTOs which were supposed to complete in 2021, 2022, even private projects saw a slower rate of development. That is why rent actually went ballistic. Not just that, Hong Kong actually saw an exodus of foreign talent, and Singapore being close to it was a beneficiary of expats. But note again, that was a world 2022 and before. Right now, China is opening up, but right now, there seems to be a recession possibly looming globally. BTOs are getting completed, and many projects in the private sector are also TOPing in 2023. Does that mean that rental moving forward is less certain than before? Point number 2, investment demand. Many have said that unlike other countries like US and Australia, which have experienced big declines in property prices, Singapore is different. Many people feel Singapore is safe because we have weeded out foreigners from buying and speculating in properties here simply through ABSD, additional buyer stamp duty. Maybe that's true, but we should also wonder, with our slow population growth, who is left there to buy investment properties? Is it all local Singapore investors? Is demand going to be still strong from the local population? You know, for Singapore couples, especially those who are both high income earners. I know many myself, and I know many who have actually bought 2 properties, one in each name. And usually for couples, they are only going to stick with 2 properties and not going to buy a third one, simply because that will incur again that 17% ABSD. But the first question is, why exactly are they buying an investment property? Quite simply this. How many times have you experienced this? When the price goes up, you have that fear of missing out, FOMO, and you decide not to hold back on your purchase. You like to purchase it right now before prices go up even higher. By the way, that's a usual scare tactic they use. Don't believe? Go down and hear for yourself. But let's look at the private property index right now. You'll see that on the far right, in 4th quarter 2022, prices are finally flattening already. Question is, what if prices are no longer climbing? Or in fact, could possibly face a decline for the next few years ahead? Would remaining investors be so keen to jump quickly on board? I can answer that with a bit of certainty because I visited showrooms in 2016, 2017, and it was pretty quiet back then. So 2022 and before, investor demand was strong. 2022 and after, investor demand seems to be questionable. Point number 3, alternatives in the market because of interest rates. Now, many property ads have gotten this impact of interest rates totally wrong. And I'm not saying about home buyers, I'm saying about investors. That is why also, previously there were families, affluent ones, who bought properties in trust in their children's name. In that structure, you have to pay full cash because there's no better way to generate monies with that cash. So if you haven't heard of it, smash the like button as you have learned something from today. I want to highlight something more important to you in terms of the thinking process. Fixed deposits right now are 4%. Even an endowment plan that I've recently featured 3.95% for 3 years is looking pretty good. That means if you have $1 million, you can actually generate $39,500 of interest return simply by parking into a plan which is capital guaranteed at maturity. Take note again, there's no need to engage any agents, there is no risk that prices drop, there is no tax that you need to pay. Simple, clean structure. For accredited investors, the horizon is even broader. They can buy high quality bonds, some of them pay 5%, and if they were so savvy to use leverage, they can still do so with wholesale bonds. My question to all of us listening here is, the world has changed from TINA. There is no alternative, TINA. Because right now, quite simply, there's so many instruments with high interest for people who have spare cash. So in total, I'll do a summary table for all of us. 2022 and before, rent, stable or strong. Investment demand, strong. TINA, there is no alternative. 2023 and moving forward, rent outlook, slightly less certain. Investment demand, questionable. Investment alternatives because of high interest, plentiful. Considering all this, I've decided to sell my HDB flat and leave the game early before everyone starts rushing for the exits. And as always, if you're looking for help to sell your property because it hasn't gone out, again, look for my links below to reach OHMYHOME. They found a buyer for me in 1 month plus and I'm pretty satisfied with the outcome. I'm sharing you my journey and my roadmap very openly, and as always, I hope you appreciate it and leave constructive suggestions below for everybody to learn further. And if you'd like to follow me further on my wealth building journey, check out this previous tutorial whereby I've shared how I'm actually going to build towards $3 million in net worth. I think that video will give you some insights on thinking rich and hopefully it can impact you in your own wealth building journey also. With that, I'll sign off from here and see you there. Take care as always. Goodbye.